have a small recap of yesterday's session. How many of you remember all the words or jargons used in the stock market? Anybody wants to summarize quickly? Okay, first we'll start with settlement. Does anybody remember what was settlement? Yes, please. Nobody knows what settlement or what is a settlement period? Okay, settlement is the duration taken for the delivery of share or money to the respective accounts. Okay. So it means that if you place a trade today for buy, today's trade for buy, you will have to get your shares and money from your bank account has to be debited. Okay, and the one who sells the shares to you has to get his money and the shares from him credited to your account. Okay, so this process is called settlement. And this takes T plus 2 days. Okay. So okay, we'll go with one by one. Everybody knows what's a trend? It's the general direction of the market. Bull, uptrend or downtrend? Bear, downtrend. Okay. What's a script? It's the short form of the stock name. So face value, everybody knows it's the value written on the share. We'll look at the uses later. Position, it's the act of placing a trade. Okay. Taking a position is the act of placing a trade. You can have a long position or a short position. Long is when you go bull. When you are bullish, you take a long position. Long position is buy first or sell first? Buy first. Buy first and sell later. What's a short position? Sell first, buy later. Okay. Long, short, done. Square off. What's a square off? When you close an open position, it's a square off. Okay. So what are the holdings? All the shares that you have with you currently are your holdings. Okay, it means a list of open positions. Okay, so an order is an unexecuted transaction. An order becomes a trade when it gets executed. Then LTP or CMP, full form of LTP? Latest trade. CMP? Current market price. Okay. So OHLC, open high, low close. Open is at 950, close is at 330. High and low are the highest and lowest of the stocks. Volume, what is volume? The number of shares being traded in a specific day. Okay, what's bid, what's ask? Bid is, are you offering to buy or offering to sell? Offering to buy. Okay, what's ask? So ask price will be the price at which you are ready to sell the share. Okay, so what is the lot size? Not applicable to shares. For shares, the lot size is 1. Okay, 1 or multiples of 1. It is the minimum quantity that you have to buy at a per order. Okay, what's a stop loss? Okay, come to stop loss. I'll give you one more sum on stop loss. Okay, so who wants to take the trade? Anybody wants to take the trade? Name a share, somebody? Anybody? Asian Paints. Asian Paints, good. Capital? 1 lakh. 1 lakh. Okay, let us say Asian Paints is being traded at 20,000 each share. This is the LTP. Okay, so let us say you want to go long, short. What's your view? Bullish, bearish? Short. Short. Okay, he's going short. That means his view is bearish. Okay, so what's your maximum loss capacity? How much can you lose on 1 lakh? 40,000. 40,000 he can lose. Maximum loss capacity is 40,000. Calculate the stop loss price for each share. Do it. Share it. Good. This time we'll stick to 2 options. No 4 options. Sorry? First option? Yes. First option? Second option. Give me numbers. Yeah. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Answers please. 28,000. Anybody wants to give a second option? Or everybody wants to go with 28,000? 28,000? Fix? Okay, 28,000. Let me check. 1,40,000. Yeah, 28 is right. Okay, so next we'll move to the next concept. Okay, what was the market cap? Market cap? What's the formula for market cap?
Number of shares, price of each share.
Number of shares into LTP. Okay, that is the market cap. Market caps keep changing. Large cap more than 20,000 crores, mid cap more than 5,000 crores, small cap less than that. Micro caps are very less market caps. Margin, you pay only a part of the amount needed. Okay, that's the margin. Each broker has different margins. It can range from 10% to 50% also, or maybe even higher, depending on the risk involved. Okay, so margin is not allowed on. See, intraday everybody knows. Okay, you square off the open positions within the day. That is, you buy and sell in the same day. That is an intraday trade. Okay, so what is not an intraday will be called equity delivery. Okay, it means you are carrying the share to more days. You are not going to sell it off within the same day. Okay, so that whatever is not an intraday is an equity delivery. Okay. Whatever is not an intraday trade will be an equity delivery. Okay, equity delivery margin is not allowed. Intraday margin is allowed, and futures and options margin is allowed. Remember this. And then the next concept that we saw was circuit filters. Everybody knows what's a circuit filter. A stock is being traded. It has an open price, an upper limit, and a lower limit. What is this called? Upper circuit and lower circuit. Okay, this can be between 5, 10 and 20%. What's a market-wide upper circuit filter? Once it hits 20%, the market stops for the day. It hits 10% or 15%, it stops for a certain amount of time. Okay? So we are done with the revision. Yeah. We'll start with what are the types of investors. Okay. So in types of investors, we have types based on the capital that you can afford to invest. Okay, based on this or the type of institution, we have 4 types. 1 is FII, 2 is DII, 3 HNI, and 4 will be retail investors. Okay. FII stands for foreign institutional investors. It is basically all the mutual fund companies and fund management companies that are registered abroad and they want to invest in the stock market. They are called foreign institutional investors or foreign portfolio investors. Both are same. FII and FPI are same. Okay. So DII will stand for domestic institutional investors. They are the mutual funds and fund management companies or banks, or it could be any fund management company of the sort that are registered in India and are trading in the Indian stock market, right? Okay. So what are these high net worth individuals? It means they are ready to put in more than 2 lakhs capital in an IPO, that means they are ready to invest large amounts in the market. Okay, 2 lakhs is a small amount for a normal market. For IPO, it is quite big. Okay, so HNI is high net worth individuals. All of these are HNIs, and they are the big people of the market. Okay, anybody identify someone here? First one, yeah, he's Mr. Late Rakesh Jhunjhunwala. He's expired within 1 year only, but he was a very big inspiration for everybody in the market. So the next one is Ramesh Dumani. The other next one is this person is Ramdev Agarwal, Gurenjo Velia, Namesh Shah. Most of them are Gujaratis. Gujaratis play with money. Okay. So this is Vijay Kedia. This is Dolly Khanna. She is a female, a woman trader, and she is an inspiration for every woman trader in Indian stock market. And then this is based on capital and types of investment. Okay. They are all HNIs. What are we now? Where do we fall? We fall in retail investors. Okay. Retail investors are anybody who has a small capital. Small capital. We are all retail investors. That is, we trade in shares in small quantities. We are not wholesale dealers. So we trade in retail quantities. Okay. So now that is based on type of institutions. Okay. Now, why is this necessary? Okay. These foreign institutional and domestic institutional investors are institutions. They have a set of people assigned to do the analysis or take the decisions as to when to buy a share or when to sell the share. Okay. So they do detailed analysis, both of these. Detailed analysis is done, which means they know the stock market in and out. So if they take a decision, it is 98% right. Okay, and what decisions they take will be available as news. That is why they say news is an important part of your investment decision making. Okay, so 98% if they are right, you can just follow them, make money. So they buy some trade. Let us say they buy ONGC. ONGC is Oil and Natural Gas Corporation of India. It's a government subsidiary company. So let us say they buy ONGC, which means they have a good idea on ONGC. Their idea is that ONGC is going to be bullish, which means you can also buy ONGC and profit. Okay. Once they exit, it means the company is not going to do well in the future. So you also need to exit, or you can do a short. Okay. So even high net worth individuals, they may not have an institution set up, but they do have some good knowledge in the market. That is why they have become high net worth individuals. Okay. So you can follow them also. Rakesh Jhunjhunwala was such a big player in the market. When he sold a share, the share had to fall down. When he sold a share, the share had to fall down because he had so many followers with him that his one decision was majority of this market's decision. Around 20% of the market used to follow him. 20% is used. Okay. So this is all available in news. You just type or you can go to money control. Okay. Anybody has 5G here? Anybody is great. Okay, I'll show you that one. Okay, now based on the duration of holding. Duration of holding, we have these two types. One is a long term, mid term, or that is it's like ambiguous. Okay, so you can consider this or you can not consider this. That is not a problem. These are not strict durations. Okay, these are just related terms. Then you have intraday players. Then you have scalpers. Okay, this long-term people, in general talk of the market, long-term is anybody who is willing to go for more than 1 year of holding. So you buy TCS today, you hold it for more than 1 year, you become long-term investor. Okay. Mid-term will be somewhere between 6 months to 1 year. It's like a acute and chronic disease. Okay. Short-term will be somewhere between 3 or maybe 1 to 6 months, and intraday is 1 day. Okay, and scalpers work in 5 to 15 minutes. They buy a share, they sell it in the next 5 minutes. Okay, they are smaller versions of intraday trading. Intraday, they buy today morning, they sell it in the afternoon within the closure of the market time. Scalpers, they buy it now, they sell it in the next 5 to 10 minutes, maximum 20 minutes. Okay, that is how they play. Now, you might have heard of a term called swing traders. Okay, this is a common term in the market. Okay, swing trade generally includes these two. Okay, it is somewhere between 4 weeks or 1 month to 3 or 4 months. Okay, it may be extended to mid-term also. Around 1 year also you can play, but this is the usual meaning of a swing trade. Maybe a quarter, maximum a quarter, that's all. Quarter is 3 months, everybody knows that. So this is how you divide based on the duration. Now you need to understand what are you in this. Are you an intraday trader, are you a swing trader, or a short-term investor, or long-term investor? Okay. Now if you are a long-term investor, you don't need to do much detailed analysis. You just need to look at how the company is going to perform, what are its future decisions, what are its future ventures. You just need to look at the fundamentals. Okay. You invest in any company as a long-term investor, just like I told you, Nifty went from 1000 rupees and got to 20,000 over the past 20 years. And this 20,000 was touched in this year. This year starting, it was at 18,000. So 2,000 in just 8 months. 2,000 in just 8 months. This is a very rapid growth. So if you become a long-term investor and you are just blindly invested in any company in January, you would have grown by almost 20%, almost 10% by 8 months. So you become a long-term investor, you don't have much risk. Okay. When you are a short-term investor, you can actually move from short-term to long-term. You just don't need to stick on to anything. Okay. You can have multiple holdings in your portfolio. So you can be a long investor on certain stocks. You can be an intraday trader on certain stocks. You can be a short-term investor on certain stocks. It is not fixed, but you need to have clarity of where you stand. Just because you have the capital, when you take an intraday trade, but it turns out into a loss, and you want to carry it into long term, meaning let us see, what happens is your capital is locked in that particular share. It is not going to go up. Okay, your capital, even if you let us say you had bought a share at 1000, it fell down to 900 in intraday. Okay, so you made a loss of 100 rupees. Now, after making a loss of 100 rupees, you think, let me take a delivery. Let me go for short-term investment. I don't want to play intraday on this because I made a loss of 100 rupees. Who wants to make a loss of 100 rupees? Okay, this loss is not booked yet. Booking a loss meaning squaring off the position. You have not squared off the position in intraday. You want to carry it forward. So, this loss is not absolute. This is just unrealized loss. So you don't want this loss. So like you think maybe it might come up to 1,100 in maybe next 1 month. We'll see, we wait and see. And it might fall. Okay. Instead, if you have just closed the position here, squared off the position here, and sustained loss of 100, no doubt, your capital remaining will be 900. You had entered into some other stock that goes up, you make a profit of 200. Your total net profit will be 100. Your capital is free to invest in any other stock. But if you hold this for a long time and by chance it doesn't come up, it keeps going down and down, your capital is also lost and you're not making any profit. You're just making more and more losses. Okay, so you need to be careful. You need to maintain a little amount of discipline in this aspect. So if you want to take an intraday trade, but it turns out to be a loss, you book the loss, come out, free your capital. You don't let the capital lock in. If you look at a long-term investment, you strictly maintain this as a long-term investment. You want to play intraday on the same share, leave that amount, play it with separate capital. Everybody understood? Anybody has doubt? I'll show you on money control. See, money control is the best website for all kinds of news and information. Okay. So you want to do fundamental analysis on a certain stock or something, you can go to money control. This is your website, money control website. Okay. You can log in or you may not log in, but you have plenty of ads which are not disturbing. Just one or two here and there. Then under this news section, under the market section, you have this thing called FII and DII activity. Okay, you click on that, it will redirect you to a page where it shows the activity of this month. Okay, you have all the activities here. How much have they sold? How much have they bought? Everything you have it here, but it is not specific for the stock. It is general for the market as such. Okay. Now, if you want for a specific stock, you search for the stock. You see this? So you search for the stock. You get this page. You get this page of you have this page of the stock. It shows you the overview. Let me explain what all is being shown here. So you have the stock price here. Okay. This is how much percent it has moved up relative to the open price. Related to open, it shows what is the day's change in the price. It has gone up by 6 rupees in today's session. That is 0.4% of the total value. So this is the NTP of the share. Now it shows you a small graph of the prices of the stock. Then if you come down, you have this detailed section here. You have the OHL and where's the sequence? Where's the sequence? It's not showing there. It's showing here. Previous course. Okay. So you have OHLC. You have the volume for today. You have the upper circuit and lower circuit limit. This shows you the yearly high and yearly low, just like days high and days low. This is the yearly high and yearly low. It allows you to estimate where the stock is performing compared to its past 1 year performance. Okay. So you can see the market cap of the same share here. You can the rest. You can see the face value here. The remaining we'll look at it later. In this, you go to shareholding section here. It will show you the percentage.
Previous close is today's or yesterday's?
Previous close is the previous market session. Today the time is 4:30, which means the market has closed. So it will be today's close. This will show you the percentage of shareholders holding. So promoter holding 25% shares. We saw what was the promoter yesterday. FIIs hold 33% shares. DIIs hold 27% shares. Public holds only 15% of the shares. Such a large shareholding in DIIs and FIIs, they hold more than 55%, okay, which is a huge amount, which means they have a good opinion of the stock, which means you can enter the stock for long term. And this is a simple analysis. Now you have a news that certain FII or certain DII from 33%, their shareholding went down to 30%, which means there is a 3% decrease in their shareholding of the stock, which means they don't have much opinion. They don't have that good opinion as they had before, which means you need to be a little careful with the stock. It might go down. Okay. The they have a good opinion, which means it's gonna go up. They exit from the stock, it means they have a bad opinion, the stock's gonna go down, you also be careful. This is one simple analysis. Day-to-day news you watch on your favorite stocks, you can do a long-term investment in the stocks. Okay. So now coming to this. Now we saw the types of orders, sorry, types of investors. We look at the types of orders. We look at the types of orders now. In types of orders, this is important when you start trading. Okay, I'll show you the trading screen once on the app. Now in types of orders, you have the limit order and market order. We first understand what are those. So you have the limit order and the market order. Okay. Now this limit order basically means you are bargaining. Let us say you are going to go out buy some vegetables. Onions are at 45 rupees per kg. But you heard that somewhere else someone is selling it for 40 rupees. So you are going to bargain 40 rupees get 20. So that is basically your limit order. It means while placing an order, you say, anybody name a share? Some share, anybody? Any share? Name some. Zomato. Okay. Zomato. So in Zomato, let us say you want to buy 5 shares, buy position, you are going to go long. So in Zomato, you want to buy 5 shares. Let us say the LTP is at 1, 2, 3, 4 rupees. Okay. But you don't want to buy at that price. You want to buy it at a little low price. You say you want to buy at 1220. Okay. You place a limit order. It means your order will stay active for buying 5 shares at 1220 rupees. Once the LTP drops down to 1220 rupees, this order is going to get executed and converted into a trade. Okay, until then this order will remain as an order. It won't be executed. This is a limit order.
We can cancel that order before executing.
Sorry?
Before that order gets executed, we can cancel that.
Yes. Before the order is executed, you can cancel it if you don't want to place the order. Or you can even modify it. Let us say this came down to 1222. Okay. 2 more rupees, if it had come down, the order would have been executed. It executes automatically. Okay. It would have been executed. But you think, okay, from 1234 it came down to 1222. Maybe it might come to 1115. So you think, I don't want to buy it at 1220, I'll buy it at 1115. You can modify it still. You can place it at 1115. Once the LTP touches 1115, the trade is going to, order is going to get executed. This is a limit order. Okay. Now the market order. Market order means that you are not ready to bargain. You don't want to bargain. It means you are ready to buy at whatever is the LTP at the moment you place the order. Let us say today morning at 10:43 a.m. you wanted to buy Zomato. 5 shares. LTP was at this time. LTP was, let us say 1, 2, 3, 3. You place a market order. This will execute at this instant. Once you click place order, once you click on this place order, whatever price is there, it will get executed. It won't wait for whatever price you set. You won't even set a price. And this is a market order. Understood now? So now we understood. We saw what is a stop loss yesterday. Right? We saw what is a stop loss. It is to minimize your losses. That is once you have taken, let us say you bought Zomato at 1200. Okay. Now your stop loss, you are bullish. But you just be careful. You think that once it comes to 1100, if it goes below 1100, I can't take the loss. So your stop loss is 100 rupees. So your stop loss price will be 1,100 rupees. Your instruction to the broker is that I am bullish on this stock, but if it comes down to 1,100, you sell it automatically. Okay, that is you will place the stop loss order. But if it goes bullish, I will place a sell order later. Okay, so this stop loss order has to be selected. Once you are placing a stop loss order, there will be one option for stop loss. There will be a checkbox. You need to click that. That is when the order will be considered as a stop loss. Okay. Otherwise, it will become a normal sell order. If you don't select this, it will become normal sell order. What is the difference between the two? Both action same. It is going to sell at 1,100, but the difference is sell order gets executed no matter what. But stop loss order gets executed only when the shares are in your holdings. Meaning, let us say instead of going down from 1,200 to 1,100, the stock goes up to 1,300. Okay, so you sell it off here. You sell it off here to book a profit of 100 rupees. Your stop loss order will get automatically cancelled once you sell it here. Your stop loss order will get automatically cancelled. If you hadn't placed a stop loss order, you forgot to check this box, it will become a normal sell order. Once it's a normal sell order, even after selling there, this order will still be active. Which means, by chance if it comes down to 1,100, this order will execute. So, one buy and sell transaction done, that is a different transaction. Now, this is equal to shorting. It's a risky trade. It's equal to shorting. So, you need to cover this position by buying it. But if you forget to buy, loss. So, that is the reason you select this box for placing a stop loss order. I'll show you how to do it. Now, there are a few more types of orders that are not useful in the day-to-day basis, but I'll just tell you what they are so that you understand what they are. One is the immediate or cancel. Okay, it means it is just like a market order. What happens in a market order? Does it execute immediately or does it wait for the price that you set? Immediate. It executes immediately. This immediate or cancel order is also the same thing. But in market order, by placing, let us say it was 1233 rupees, but while you select the number of shares, let us say 5 shares, and you go to click the place order button, around 5 to 10 seconds would have passed. This stock might have come to 1240. That can happen because 5 to 10 seconds stock prices can fluctuate very much. So 1240 it might come. So it means that the stock order will get executed at 1240 if it is a market order. Now, immediate or cancel order, it executes immediately. Okay, or it cancels the order. This is useful when, let us say LTP is at 1200. You want to buy it at, let us say buy it at 1119. 1119. Okay, you don't place a market order for this. You place an IOC order. It means if someone is ready to sell at 1199 at that exact same moment, I am gonna buy. Otherwise, you cancel the order. I don't want it when it comes down. Okay. The purpose of it is not for retail investors, it is for big investors when they place large volumes of trade. One more thing is, let us say, one more aspect of this is the size of your, the number of stocks that you are going to buy is 5. Okay. Now let us say large investors, they don't buy 5, 10. Okay. They buy it in thousands. Let us say the same 1,233 price. They want to buy 5,000 shares. Some large investor, they want to buy 5,000 shares. Okay. At let us say 1230 or let us say even 1233. Okay. Now, immediate or cancel, what happens is, this is not required now. We'll look at it later. We'll see, immediate or cancel is not useful for retail investors. Just remember that. Just remember the concept. Now, let us see what is a GTC. GTC stands for good till cancel. Okay, it is similar to the stop loss order. It means until it is cancelled, it will stay. It will stay active. Now, once we sold here, the stop loss order was cancelled, right? Once we sold at this price, the stop loss order was cancelled. Until then, it was active. The exact same concept in goodwill cancel. The one parameter or one feature of the order is that any order that you place, except the goodwill cancel order, any order you place, it is valid only for 1 day. Valid for 1 day. You buy Zomato at 1220, you place for 5 shares today. LTP does not touch this price. LTP, the lowest price it has touched is 1225. Lowest price it has touched is 1225. You are placing buy order at 1220. It will be valid only for 1 day. So tomorrow, if you want to still buy it at 1220, you need to place an order again. Day after today, even tomorrow it doesn't touch this price. You want to place, you want to still buy it at 1220 only. Day after tomorrow, you have to place a new order. So it is valid only for 1 day. But a goodwill cancel order will be the same limit order. It will be a limit order. But its validity can be extended from 30 to 90 days. Or until you cancel it order. That is the thing, goodwill cancel order. Validity can be extended from 30 to 90 days. Depending on the broker. Some brokers allow 30 days, some brokers allow 90 days. Okay. Now the use of this is that, let us say you want to buy this same share only when it reaches 1000, but you can't keep monitoring it on a day-to-day basis. So what you do is you place a GTC order at 1000 rupees. Once the LTP touches 1000, the share will execute. This is GTC order. This is a very useful order. If you are not a daily trader, you don't look at the market daily, this is very useful to you. Now we'll see the all or none, which means, let us say a large investor, 5,000 shares he want to buy, but he doesn't want to buy it in parts. He doesn't want to buy 250, 350, like that in parts. I'll tell you what is buying in parts. Okay? So once you place a large order, let us say for 1,000 shares of some XYZ company. Okay. Now let us say this is at 50 rupees you want to buy. Okay. Now LTP is at 51. 51 is the LTP. What happens is some sellers would be ready to sell even at 50 rupees. Some sellers would be ready to sell at 50 rupees. Okay. What happens is these sellers won't have all the 1000 quantity that you have. All the 1000 quantity that you have may not be available with them. Maybe one person has only 200 shares. He has only 200 shares. You have placed a buy order for 1000. What happens is once he places a sell order for 50 rupees for 200 shares, 200 shares will be bought in your name. Remaining 800 shares will be open order. Okay. Once another seller, he places for 50 rupees only, he places, let us say 450 shares. Immediately this will be reflected here. So you will have 350 more shares, 350 more shares order pending. This is execution in parts. Order will be executed in parts. The bad thing about this is your brokerage that we spoke about yesterday, that 0.02 rupees the commission that the broker takes is on a per order basis, per executed order basis. For unexecuted orders, it is 0 rupees. Okay. For a per executed order basis, he takes a commission of 0.02 rupees, which means if you had bought 1000 shares together, the brokerage would have been for one order. Now since you bought it in 3 parts, that is 200 was the first order, 450 was the second order, 350 was the third order, you will pay 3 times the brokerage. You got the concept? That is, to avoid that, you go for an all or none order, which means you want the whole 1000 shares to be executed together. Otherwise, you don't want to buy it. You don't want to buy it in parts. You buy it as a whole. Okay. So the next is minimum fill. This is not actually required. Minimum fill is not required. Disclosed quantity is not required. Okay. Now important part is corporate actions. Now we spoke about something called the face value of the share, and we saw that for HDFC Bank it was 1 rupee. In the money control website we saw that. Okay, now let us say HDFC Bank was 1,500 and odd. Share price was that. LTP was 1530 something. Okay. So depending on this, the company can actually take some actions. Those are called corporate actions. What are these actions? We will look at them one by one. Okay. These are very important meaning. This has become a frequent happening in the market. So many stocks, many companies decide to pay dividends. They either decide to do a stock split or bonus issue. I'll tell you what are the reasons behind that. So dividend, we spoke about dividend yesterday. Dividend is a share in the profit of the company. It is optional. It means the company can decide to give out a dividend or it cannot do it. And it is usually in the format. The format is very important. Okay? The format is rupees, let us say 1.5 per share held. It means if you are holding 100 shares, you are going to get 150 rupees as the dividend. This dividend will be directly credited in your bank account. Okay, so instead of 1.5 rupees, let us say it was 7.5 rupees, you will have got 750 rupees. This is an additional income. Apart from your share price going up, you get additional income. So dividends are a bonus kind of thing. Okay. So dividend yielding stocks are usually large cap companies, and most of them are government owned companies like ONGC, IRCTC, Indian Oil Corporation. All these need dividend on a regular basis. Okay. It is not like they have to, it is that they do. That's it. Okay. So dividend is one thing. It is not a mandatory thing, it's a optional thing. Okay. So dividend we are done. We'll look at stock split and bonus issue together.
Dividend given because company is doing well?
Yes, company is doing well. It wants to share the happiness with the shareholders because they have given their capital. That is why the company has been performed. So it is like a boost to the shareholders. A dividend, if they give a dividend, the shareholders are happy. If they are happy, it means that they will continue to invest in that company. They will continue to buy that share. It is like a boosting. Okay, it just makes you happy, and your psychology is that you want to buy more. Now, looking at stock split and bonus. Okay. Now, stock split, the format is X is to Y. Okay. Now, in a stock split, let us say it is 1 is to 5. What happens is, let us say there is 1 lakh shares being traded. That is the number of shares being traded in the market. Total number, not the volume. Total number of shares is 1 lakh. Okay. Now the company decides to do a stock split, or it decides to give a bonus issue. Why does the company do this? It does this so that the number of shares increases. The number of shares from 1 lakh, it's going to increase to any amount that the company decides. Why do they want to increase the number of shares? They want to increase the number of shares because they want more people to play in their stock. If there is 1 lakh shares, there is going to be a limited amount of people who are going to play with the stocks. If there are 5 lakh shares, many people are buying. This brings down the volatility and increases the liquidity. Everybody knows what's liquidity. What's a liquid cash or hard cash? It means the cash ready to be transacted. So you have a property, it's not a liquid thing. You need to first sell the property, take the cash, and then make a purchase. So that is an illiquid asset. A liquid asset is something like your cash. You have cash 500 rupees, you go to a shop, you want to buy something for 200 rupees, you give 500 rupees. So it's a liquid cash. Same thing, stocks can be liquid, which means it can be easily sold. And the entire value can be realized. Okay, that is liquidity. So when this 1 lakh share become 5 lakh shares, the number of people participating in the trades of the share will increase, which will bring down the volatility. Just like we saw large cap companies, more shareholders are there, volatility is less. Because when many people are there, the average will be stable. If you look at a study of 1 lakh people, the average height will say is 5'11". The average will be stable. But if you look at 2 people, let's suppose Jeevan and me, he is 5'6". He is 5'6" or something. I am 5'10". So we will be 5'8". 5'8", 5'11", different averages. But the number of people that you look at, this average may be different from the total average. That is why you take a larger sample, you get a stable average. Everybody understands that concept, huh? So based on that, you have a large amount of people trading the stock. The volatility is less. Okay? Liquidity is more. Meaning, if one person is not willing to sell, someone else might be willing to sell. So it is easily saleable. Okay? So liquidity increases. This is the reason between a split and bonus. One more thing is, when let us say I want to sell my laptop. My laptop costs 50,000. You have only a capital of 20,000, but you can't be able to buy a laptop. That is just assume. But now, with the laptop, let us say I want to sell my RAM, just my RAM, or my hard disk. I want to sell my hard disk. Let us say for 10,000. Will you be able to buy it or not? Because you have 20,000 capital, you will be able to buy a 10,000 product, not a 50,000 whole product. So when a stock splits, what happens is, when you are splitting a stock, the number of shares or number of stocks goes up. So you break a chalk into three. You break a stock into chalk into 3 pieces. The number goes up, but holding it is easy. Holding it in the sense affordability. Affordability is easy, which means the price comes down. When number goes up, the price has to come down. The concept is, even split in the stock split and bonus issue, the market cap remains the same. Market cap has to remain same. Okay, market cap cannot change. So what does market cap contain? It contains the number multiplied by the stock price. So if one goes down, the other has to go up. Or pull up. If one goes up, the other has to come down. Proportionately, if one share is split into 5 shares, LTP will go down by it will go down to 1/5. Proportionately it goes on. Okay, that is the concept. Now, what happens is, when the price comes down, can even small time investors trade? With MRF, for the example, 1,50,000. Not everybody has that much capital. Okay, but let us say they split it into 2. They'll split it into 10. We'll take it for easy calculation. They split it into 10. So each share will be 11,500. 11,500. So 11,500 is a small amount. More people can trade than before. That is one reason. That also increases the number of people trading, which again decreases volatility, increases liquidity. This will lead to stability of the stock price. Stable stock price meaning the company is performing well. That's all. Okay. So now what happens in a stock split? A stock split is usually announced in this way. 1:5 in ratios, which means one stock is split into 5 parts. This can be 2:3, not usually, but it can be 2:3, 1:2, 1:3. It can be in any forms. It means these many number of shares are being split into these many number of shares. Now, if one is split into 5, let us say LTP was 1,000, it will become 200. Soon after the split, whatever was the last traded price, that will become 1 by 5. Okay, this is a stock split. Now what happens is, the number of shares has increased, price has come down, more people can afford to buy it, more people are going to enter in the market, more number of shares, more people can hold, which means more people are entering, decreases volatility, increases liquidity.
What happens to the number of shares already owned? Someone owns 10 shares.
Someone holds 10 shares, it will become 50 shares. Every shareholders will be split into 5. No matter you hold or you don't hold, every share in the market is going to split into 5. So if you are holding 14 shares, it will become 70 shares. That's the count. That's stock split. Now bonus issue, you don't split the share. In bonus issue, what happens is, it is issued in the reverse ratio. Okay? It is issued in Y/X. Meaning, for every shares held, that is X number of shares held, you will get Y number of shares for free. A bonus is something that is given for free. Okay. In that, the ratio was X is to Y, which means for every X number of shares held, it is split into Y number of parts. Okay. There, it is given ulta. It is usually given like 2:1, or 3:2, or 3:1 in this ratio. Meaning, for every 2 shares that you hold, you will get 1 extra share for free. Every 3 shares you hold, you will get 2 shares for free. Ratio is ulta, remember that. Or if you don't remember it, you can just Google it. Just Google format for stock split, format for bonus issue, you will get the meaning of the ratio. You will be confused if this is the number of shares you hold or this is the number of shares you hold. So this does not mean for every 1 share you get 2 free shares. It means for every 2 shares that you hold, 1 free share you get. So, in bonus, what happens is, you are getting a stock for share for free, but that does not mean it's free. Okay? Even here, the market cap should remain same, which means if they are giving it for free, it means the number of shares is increasing. So price has to naturally come down or go up? Come down, proportionally. Now, what is the difference between a stock split and a bonus issue? You might be having that confusion. For that, we look at this. Okay. Here, we can see that, I forgot to mention this. In stock split, the face value, which was 10 rupees, is split into 5. Which means the new face value is going to be 2 rupees. Okay. A stock split means face value is going to split. One stock is going to split into 5 parts, which means the face value of 10 will be split into 5 parts. 2 rupees will be the new face value. Okay. In bonus, the face value is going to remain because the stock is not splitting. You are adding new stocks to your holding. Okay. Now the difference is in stock split, face value remains same. Goes down. This is a 1:2 split. This is a 1:2 split. Face value goes down to 5 rupees. The number of shares was initially 2 crores. So 1:2 split. The number of shares is going to go to 4 crores. Now the share capital was 20 crore. Share capital remains same because market cap has to remain same. Now this reserve will come down when we discuss bonus. Total equity is for 80 crores. We look at bonus now. Bonus face value remains same. This is a 2:1 ratio bonus. This is a 2:1 ratio bonus. So for every 2 crore shares, extra 4 crores are added, which becomes 6 crore shares. But share capital is 60 crore. This is not the market cap. This is the market cap. This is the share capital. The difference is that apart from the shares being traded in the public market, okay, there is something called as a reserve. These are held with the company. They are put into the market only when needed. In stock split, reserves are not touched. In bonus issue, the stock is not splitting. But where will that extra It was a 2:1 bonus. Where did this extra 2 shares come from? If the stock is not splitting, where did it come from? So it has to come from somewhere. That source is the reserve. From the reserve, they redirect it into the public market. So the new shares are arising from the reserve. This reserve is the component of market cap. So market cap includes the shares being traded in the public as well as the reserve. Okay. But in general terms, only this is taken as the market cap. Only when it comes to bonus issue, this whole formula is applicable. Otherwise, this is equal to market cap. Okay. Reserve is not applicable. So in bonus, the reserve comes down. The extra 40 crore that had to be put in the market comes from the reserve. So reserve, which was initially 60 crore, has fallen to 20 crore. That 40 crore has been put into the market. So the share capital would be 20 crore plus 40 crore, which is 60 crore. But the total market cap remains same, 80 crore, 80 crore. This is the difference between a bonus and this. Both are positive terms for shareholders, split and a bonus. Because again, same thing, more number of shares, less price, more affordability, more people are going to buy the shares, more people are going to buy, less volatility, more liquidity, more affordability, which means prices are going to be stable, risks are less. More volatility, more risk, less volatility, less risk. Okay, this is the difference between a stock split and a bonus share. If you want to write down something, you can write down the formats. In all formats, in these three, X is the number of shares that you hold. Y is the number of new shares going to be added. So in stock split, 1:2 meaning for every 1 share you hold, it's split into 2 shares. In bonus, 2:1 meaning for every 1 share you hold, 2 shares extra added. Rights issue will do it. We'll see rights issue after IPO because that will be easier to understand. Now we'll see what is a buyback, share buyback. From the term itself, we can understand that a buyback, meaning the company is buying the shares back. Okay. Now let us say Wipro is being traded at 1200. That is the LTP of the offer. Like that. That's what offer. So Wipro is being traded at 1200 rupees. Okay. Now the company is going to buy back some shares out of your holdings. They don't want so many shares being circulated in the market. So let us say there is 1 crore shares in the market, they don't want so much. They want some shares for their personal use. So they're going to buy back, let us say 2 lakh shares. Okay. This 2 lakh shares will have to be bought back from the public who are holding this 1 crore share. Right? So they offer a buyback for these 2 lakh shares that they need. They're not going to buy the whole 2 lakh from one person. They're going to split it equally. If you're holding 10 shares, which is 1 crore, if you're holding 100 shares, which is 1 crore, you're eligible for a buyback of 2 shares. Okay, that the company decides. So for every 100 shares you hold, the company is ready to buy back 2 shares. So if you're holding 200 shares, the company is ready to buy 4 shares. Okay. So for 1 crore, they want 2 lakhs back for their personal use. They want to give it to someone else, some venture capitalist or someone, or they want to hold it. They want more ownership in their company. They want to hold it. So any reason you can. So they are ready to buy back. They want buy back at this price. If you are giving your share to someone, you need to have some profit now. That is why you are investing in the stock share market first of all. So they will be buying back at 1,400 rupees. The market price will be this much, but they are ready to buy back at 1,400. So you have an instant 200 rupees profit. Okay, so this is the reason for a buyback. The reason and what happens. So they are ready to buy back at 1,400. The format is not actually mentioned. It will be mentioned as number of shares per number of shares. So it will be 2 shares for every 100 shares only. Right? That will be the buyback ratio. It won't be in a ratio, it will be mentioned in a statement. Number of shares to be bought back per number of shares held. Okay. Now, after buying back, even immediately, let us say you've sold 2 shares to the company. Okay. Even after that, immediately you can buy again at 2,200 because the market is still trading at 1,200. So instant 200 rupees profit. In just one day, you make 200 rupees profit. So buyback is also a good thing. Buyback meaning the company's promoters have a higher confidence in their own company. That is why they want to gain more ownership. They give you free, it is positive. They want to take back the free, it is positive. So all these are positive impact on the market. None of them have negative impact on the market. Everything boosts the psychology or the morale of the shareholders. Okay, we'll look at rights issue next. Yeah. Important dates in corporate action. Now let us say that I held the shares of TCS last year. I bought it in last October, sold it in December. Now I don't have any TCS share. Now let us say TCS has declared a dividend of 50 rupees per share. I had 50 shares. So I am entitled to 2,500 rupees of dividend. But am I? Because I currently don't have TCS share right. So how do you select who are entitled to the corporate action, to the benefit of the corporate action? So we have some dates in the corporate action. Okay. We have 4 dates. Of these, 2 dates are important. Ex date and record date are very important. Okay. So we look at the first date, which is the declaration. This declaration date is when the company decides to do some corporate action. Let us say today, Wipro decides to give a dividend. They want to give a dividend, but they don't want to give it today. They are going to give a dividend maybe in November or December. They haven't decided exact date, but they have decided they are going to give dividend. So that will be the declaration date. When they announce that they are going to take some corporate action, it can be stock split, bonus right, buyback or dividend. That is a declaration date. Now this ex date and record date go hand in hand. It means if you hold a share from ex date to record date, from ex date to record date, you are eligible for the dividend. You mean the shares has to be in your Demat account from the ex date to record date. This is the minimum time that you have to buy. This is the maximum time that you have to hold. Okay. So let us say the ex date is 10th of October and the record date is 12th of October. Okay. So you should have the share in your Demat account on this day and you have to hold it through 11th also until the closure of 12th. Market closing 3:30, at least you will do it. 13th October you can sell it. And you have to buy before 10th. You can't buy on 11th and hold it till 12th. You have to buy at least before 10th. And you can do whatever you want after 10th. In between this, the share has to be in your holding. But the catch is, we have a T+2 settlement date. Right? So if you have to have the shares in your Demat account on 10th, you should have bought it on 8th. So that after the T+2 settlement, you have the share on 10th. So this will be the maximum duration that you get to buy. At least before, at least 8th you should have bought it. That is why 10th you will have it in your Demat account. You can hold it up to 12th and you can sell it. Let us suppose you bought it here, you sold it on 11th and again bought it on 12th. That is not applicable. You have to hold it throughout 10 to 12. Okay. So 8 should be, this T+2 plays an important role here. This is the ex date, this is the record date. Okay. Ex date, record date. Now payable date. What is the payable date? Now let us say this 10th and 12th were the ex-date and record date for some company XYZ. They are planning to do dividend. They are planning to give out dividend of 1 rupee per share. They announced this on, let us say, August 1st. What date will this be? Will it be declaration X, record or payable? Declaration, this will be the declaration date. The X date is 10th, the record date is 12th. Now they have to pay the dividend to anybody who has held the shares between these dates, right? That date will be called the payable date. That's all. So important are the X and record. You hold the share from X to record, you do not have to worry. Everything else will happen automatically. So once the declaration is done on the declaration day, you just wait for when the stock will be at a good price to buy. You buy it before the X date, 2 days before the X date. You hold it until record date. After that you can do whatever you want. You sell or hold it, that is your choice. You will get whatever that happens in the market. So on payable date, if they are paying dividend, they will pay dividend. Or if there is a stock split happening, the split will happen on the payable date. If they are giving bonus, the bonus will be credited on payable date. Everything will happen on this date. This is not necessary. Only X and record. Okay. Yeah. Now, actually, there are just 3 more slides. Okay. But the primary market concept is a big thing. Maybe we can take it tomorrow. So we'll do a primary market and indices we'll do tomorrow. We'll look at the economics. So economics meaning we have spoken so much: brokerage, tax, income tax, interest rate. Then we've spoken about LTP, face value, so many amounts, so many figures, so many numbers. We are not confused as to how much profit are we going to make. We are not sure. So economics will tell you what is will split everything. So now on any trade that you do in the market, okay, you will have certain charges that you are liable to pay. Okay, we have a list of all the charges that you are going to pay. These charges are going to go out of your hand. Okay. In this, some are going to go if you make profit. Some charges will be applicable no matter if you make a profit or loss. Okay, we look at both. Now, brokerage. Brokerage is on a per executed order basis. Brokerage for discount brokers is between 0.02 to 0.2% or 20 rupees, whichever is lower. So discount broker, let us say, on what is this 0.2%? On what is this 0.2%? The 0.2% will be on the total value of your trade. Meaning, you want to buy a share which is being traded at 1,000 rupees. You want to buy 10 shares of this. Your total value will be 10,000. 10,000. So you would pay a brokerage of usually it is 0.02%. 0.02% on 10,000, which comes out to 20 rupees. 20 rupees. Yeah, it's going to come to 200 rupees or 20 rupees, whichever is lower. So you are going to pay only 20 rupees, not 20 rupees. Okay. Now let us say you don't want to buy for 10,000. You want to buy 10 shares which are being traded at 25 rupees. So 250 rupees into 0.02%, which is 50 paise. 50 paise. That's going to go from there. Right? So that is the brokerage. This you pay on a per executed order basis. This doesn't matter if it is a buy or a sell. Okay. So you will be paying the brokerage 2 times. One on your buy order, the other on your sell order. You bought at 25 rupees, 10 shares you bought. Okay, so you will be paying brokerage once here for buying. When this goes up to 35 rupees, you will be selling the share for 350 rupees. Even then you will be paying this much brokerage. So it will be 210 transaction, 1 by 1 cent. Okay. This charges is usually in discount brokers. If you take a delivery of the equity, we saw what is a delivery. Anybody wants to tell what's a delivery of the share? Sorry?
You hold it for
More than 1 day.
More than 1 day. If you take a delivery, most brokers give you free. There is no brokerage at all. So you buy even 1 lakh worth of share in a delivery basis, it will be free. These are offered by discount brokers. Traditional brokers, we are not going to talk because we are not going to open any account in traditional brokers. Now, apart from these, what are the other charges that we have? We saw brokerage. We are going to see security transaction charges. This is imposed by the exchange. Okay. The first one was a commission to the brokers. This will go to the exchange. Okay. This is for record keeping, 0.1% per trade. Next will be transaction charges. This is for every trade that you make. The first one was for record keeping, then the second one was for record keeping, third one is for every transaction, which is 0.0035%. All of these on the total capital, not on the share price. It is on the total capital. You understood how to measure calculate total capital. So total capital will be 250. All these are applicable to 250. For per trade, meaning it is for both buy and sell trades. Okay. So GST 18%. This is also applicable on that. On the total charges that we have seen. On 1, 2 and 3, the sum of 1 plus 2 plus 3 on this 18% is applicable as GST. Not for capital. Remember, so 18% of capital is huge. You won't even pay 5% profit. How will you pay 18%? So 18% is on the sum of the charges of the first three: brokerage, security, and transaction charges. That will be GST. Now SEBI charges is rupees 10 per crore transaction. If your total capital is 1 crore, they will take 10 rupees as charges. So if your total capital is 10,000, you will pay only one paisa. That is negligible amount. Stamp charges, again 0.003% is negligible. That is only applicable on buy trades. So if you look at all this, your brokerage and the security transaction, they play the major part of the charges. So that will fall between on a practical basis anywhere between 0.1 to 0.3 or 0.4% on the total capital. Max to max 0.5% on the total capital. So if you have to make a profit, this will be on buy and sell both. Okay. So if you have to make a total profit of, if you want to make at least zero net profit, you have to have an increase. If you take a buy order at X rupees, you have to have an increase by at least 1%. To cover 0.5 on buy and 0.5 on sell, it has to go up by at least 1% so that you have zero net profit. So above 1%, so 1% is your break-even point. This is one more term, break-even. Okay. This is not used in the market, it is used in business. So 1% is your break-even point. Above that is your profit. 1% also doesn't happen usually. Discount brokers charge you very less. If you take delivery, it is even less. If you do an intraday, this will be the highest that you will pay. So this is the charges. Every broker shows you the charges before placing the order. If you go to place an order, they'll show you the charges down there. They'll show you how much capital is required to buy the share. Beside that, they'll show you the charges that you have to pay. Usually 0.5 paise, 0.5 rupees, 0.6 rupees, 1.13 rupees, like that only will be. If you execute transactions for 1,000 rupees, okay, then they'll show you there itself. So you can decide whether to buy or not, depending on the charges. Now, apart from this, even taxes are important. The taxes that you pay, apart from goods and service tax, that is GST, there are certain other taxes that you have to pay. which first is ITR. ITR. Everybody knows what's an income tax. Okay. The new slabs are 0 to 2.5 lakhs, 0%. Then 2.5 to 5 is 5%. Above 5 it is as per the slab. You can look at Google at any time. So most of us will fall at somewhere between this. So for 5 to such 2.5 it will be 10%. So as per your income tax, this is chargeable only on your profit. Only on your profit. Only on your profit. So if you make a profit of 2.5 lakhs in the stock market, you are liable to get 5% as income tax. Only on the profit. Same way, apart from income tax, as per your slab you have to pay them. You can have many other sections, 18C, 18D, 18DD. These are all your tax exemption sections. Okay. This we look at in personal finance. I will be taking one more class on that also. Apart from income tax, there is one more concept called capital gain. Okay, capital gain is nothing but the profit made on transactions on capital asset. What is a capital asset is defined by some section. I forgot the number of the section. A capital asset is any asset in which you invest and it has the potential to appreciate. It can be land, it can be houses, it can be any other buildings, any building properties. It can be your shares, it can be your government bonds, it can be your vehicles, it can be it can be your other assets like gold. All these are all capital assets. Okay. So on this you have to pay something called a capital gain tax. Now this is in two parts. One is short term, the other is long term. Unlike the type of investors that we saw, it was not a fixed duration, but here it is a fixed duration. All long-term capital gain is on holdings more than 1 year. Short term, less than 1 year. Okay, short term is less than 1 year. Okay. Now, what does this 1 year mean? So, if you buy a share today, you hold it for 12 months, you sell it later. You hold it, you buy it today, hold for 12 months or 1 year, you sell it after 1 year. That will be liable to long-term capital gain, LTCG, long-term capital gain, which is 10% margin. Okay, this is for shares. For properties, it is actually 20%. Real estate and properties, it is 20%. For shares, it is 10%. Is it 10%? Yeah, it is 10%. It is 10%. So, one trick here is you don't hold it for 1 year. You sell it off on the 364th day, buy it again at the same price. So, it does not consider a long-term capital. And this is applicable only on profit account. It is not applicable on the capital, it is only applicable on profit. So, you buy some share for 1 lakh today. Next year, 366th day, you sell it for 2 lakh. You are going to pay LTCG or long-term capital gain only on the difference of 1 lakh. That is the profit of 1 lakh. Okay. Now, short-term capital gain is going to be 15%. I am not sure if it's 10%. It is actually 20%. I need to look up at this. I will let you know tomorrow. Short-term capital gain is at 15%. Short-term capital gain is if you hold it for less than 1 year. Okay. So, which means you buy it today, except intraday. Short term does not include intraday. It should be more than 1 day and less than a year. More than 1 day and less than a year. Okay. So it does not include intraday. You buy a share today, hold it for 1 month, you sell it again. This profit you make only on the profit. STCG is applicable. 15% tax. These are compulsory taxes that you have to pay. There is no exception. Yeah, LTCG has an exception up to 1 lakh. So, you buy a share today. You buy a share today at 1 lakh. let's say next year December you are selling for 2 lakhs, your profit is 1 lakh, your LTCJ is exempted up to 1 lakh. You don't have to pay tax on this 1 lakh. Let us say you had sold it for 2.2 lakh. Now your profit will be 1.2 lakh. Okay, so you will have to pay the LTCG on 0.2 lakh. 1 lakh exempted. So only on 20,000 you are going to pay LTCG. So investing in stock market is relatively very rewarding when compared to other traditional assets. So I think that is for today's class. Maybe we'll look at a practical session of how to place an order 5 minutes. We'll look at IPO and indices and derivatives tomorrow and we'll finish the class. We'll have some practical sessions if you want. Maybe I can teach you the importance of fundamental and technical analysis now, 5 minutes. I'll show you what is the importance and what are they. See, every company has to have something called as a balance sheet. For economical background or financial background people who are studying commerce and all, they know what is a balance sheet. Okay. Balance sheet is nothing but a statement, just like your bank statement. You would have seen your bank statement, how many credit, how many debits have happened, what is your total net balance at the end of the period. Okay, just like that, balance sheet is submitted every quarterly by your company. Every quarterly, meaning in a year 4 times they submit their balance sheet. This is a statement of your profit and loss of the company. Wherever they return profit, wherever they return loss, everything is in the balance sheet. It also includes your investments in assets and liabilities. Okay, it shows you or everything in the statement. Now, when you study a balance sheet and you assess the company, if they are making consistent profit, it means the fundamentals are good for the company. When it is consistently making losses, fundamentals are bad. So this is what we call fundamental analysis. Fundamental analysis. Okay. This has many components like P/E ratio, PB ratio. This is to profit to earnings ratio, profit to business ratio. There are many ratios, many values. You have lots of them. All these come under fundamental analysis. Now, the importance of fundamental analysis is you know how the company is going to perform based on their constituents or their assets or their people, the CEOs and everybody. Based on the insider information also you can assess the fundamental analysis. This is useful in long-term investment. Not at all useful for intraday. It is only useful for long-term investment. So short-term or intraday trades cannot be taken based on fundamental analysis. Okay. So fundamental analysis is for long-term trades. And we'll look at one more exception for fundamental analysis. Before that, we'll see what is technical analysis. Now, earlier when I showed money control, there was a graph. This graph was the graph of the LTPs of each day plotted. Okay. So this is a graph. Now technical analysis is studying the graph and using statistics to predict where it might go. From here will it come down, from here will it go up, from here will it stay like this. That is what you call technical analysis. Technical analysis. Okay. Now technical analysis is so powerful that you don't have to have knowledge of finance. If you have little knowledge of patterns is like geometric patterns. Everybody knows what is this. What is this? Triangle. What is this? Sorry? Rectangle. That is what you call patterns. That's all. If you have this geometrical pattern knowledge, you can do technical analysis. Apart from this, very basic statistics. Okay, so technical analysis can be done by anybody who has knowledge in these two. They don't have to have the financial background. They don't even have to understand what is a debit transaction, what is a credit transaction. They don't have to understand what is profit, what is loss, nothing. They understand only this much. You can predict if it's going to go up, if it's going to go down, or if it's going to go sideways. I'll show you a practical example tomorrow if you want. Maybe I can record a small intraday trade tomorrow for you. I will see what I can do. Now, how powerful this technical analysis is, you can do scalping. We saw what is scalping. Scalping was a 5-minute to 50-minute trade. You can do such short trades on technical analysis, or you can do as long as 5-year trades. Long investment also you can do based on technical analysis. Now, the exception to both fundamental and technical analysis is news. News, bad news, good news. It affects fundamental analysis and technical analysis. You predict using fundamental analysis that the company is going to do good in 5 years, for next 5 years, or you predict in technical analysis that the company is going to do good for next 1 month. Doesn't matter if there is some tragedy or some happy news in the market. Let us say TCS was given a 800 crore fund from the government. So that's a big news. Even if you have predicted from technical analysis that TCS is going to fall down, once this news comes in, this is going to go to bullshit. This is going to go. So news is the main thing. Apart from that, if there is no significant news, technical analysis and fundamental analysis are going to work. Technical analysis, depending on how well you can, how much knowledge you have on these two, or how well you understand these two, your accuracy can range between 50% to 90%. You don't have to necessarily keep looking for news. You can, based on technical analysis, you can take trades. Fundamental analysis accuracy will be, only for long term trading, will be somewhere between 16% to 18%. Okay? Because fundamental analysis is based on balance sheet that is displayed in the public. Okay? There might be so many insider things happening that are not seen on a balance sheet. So its accuracy is relatively less when compared to technical analysis. We'll look at one order placement page. We'll see how we can place it. This is Angel 1. Angel 1 is a discount broker. This is the page of Angel 1. This is how it is. Once you log into Angel 1, you just need to enter your mobile number and you will get an OTP. After that you will log in. Once you log in, this is the home page that you see. Now in the home page you can see there are various things. Now a watch list. What is a watch list? It is the list of your interested stocks that you would like to look at. Okay. The watch list is the interested stocks that you would like to look at. It is like a bookmark section. Okay. So all the interested websites that you would look, you would bookmark them just like that. You just save them there so that you can monitor them on a day-to-day basis. This is watch list. You can add any number of shares. So in overview, you can, if you select one particular share, when you hover over it, you look at many options. This is a buy button. This is a sell button. This is, there is an add to cart button. The next is the overview, and this is the flag button. You can flag it with anything. That is not required. So we look at what is a buy button. So when you click on buy, it means you are going to place a buy transaction or a buy order for Luxidia. This will be a order pitch. This is how we place orders. Now here we will look at the script of the company. This is LTP. This is the daily change. It has gone down by 16 rupees today. That is 1.16% today. So that will be indicated in, if it had gone up today, it would be indicated in green. So this is the LTP. Now here you can select which is the exchange that you would like to buy it from. Doesn't matter whichever exchange, as long as it is available in both exchanges. Okay. You don't need to worry if it is NSE or BSE. You can place the transaction anywhere. I can place it even in BSE. Okay. So this is a buy sell figure. You had clicked buy there, but you wanted to change your mind that you want to sell it now. So just click this. You just click on sell. This will immediately turn into a sell order. Okay. So I want to buy, so I click buy. Now this is regular order. This is regular order. This is stop loss order. The 7th section we are not going to see now. In regular order, we will see what is the product type. Are we going to choose intraday or delivery? Intraday, I told you intraday order. It squares off immediately at 3:30 if you don't sell it. It automatically squares off your buy or sell position at 3:30 when the market closes. If you do it before that, it doesn't square off on its own. But if you haven't squared off on your own, it will do automatically. So you don't select intraday for safety unless and until you are not doing the short sell. So we'll select delivery. This is maximum, and delivery you get free brokerage. Okay. So choose delivery. You can even perform intraday transaction on delivery also. So best thing is choose delivery. Choose delivery. Here enter type quantity. Choose 15 quantities. Price. You have to enter price here, but there is a toggle button here to differentiate between a limit order and a market order. Since it is at market order, I am not able to enter the price. Whatever is the market price, it will keep executing. Once I toggle this button, it will turn into limit price. Now I can change the price to 1400. This is a limit order. Okay. This will show you the available funds in your account. This will show you the required funds for placing a buy order of 15 quantity at 1,500, 1,400 rupees. You need 21,000 funds. This will be your charges of 25 rupees. And you can pay, this option is relatively new. You can pay 21,000, place a buy order now. Okay, this is the order section. If you want to place a market order, you just toggle this button. It is more or less same in all brokers. Okay, so you toggle that button. Now you can't edit the price. You can't edit the price. It will execute at whatever is the price. When you click on this, immediately when you click on this, whatever price is there, it will execute. Okay. So we look at stop loss order. Once you have bought something, you are going to go into stop loss order. We will look at this tomorrow. We will look at market depth. Market depth. This is buy price, this is sell price, this is orders quantity, orders quantity. Okay. What it actually means is that in Lux India, if it was between 9:15 to 3:30, it will show how many people are ready to buy at what price. So, if the LTP is 1452, okay, I want to buy, I place a buy order at 1420. Okay, it will show here. Let us say for 10 shares. It will show here as 10 order, quantity 10, one order 1420. Okay, like that, anybody who places an order, everybody's details will come. It allows you to know what is the general idea of the market, where at what price many people want to buy, or at what price many people are ready to sell. So if somebody is ready to sell at 1450, you can place a buy order immediately here, even if the LTP is at 1452. So that detailed view will be here. Okay. Apart from this, you can look at this chart. This will show you the OHLC. What was the open, high and low, close? If the market is still running, this close will be previous day's close. If market is closed, this will be today's close. Okay. It will show you average price is not required. Volume it will show. What is the bid ask? 1450. It will usually be near the LTP only. Now it will show you the upper and lower circuit here. Upper lower circuit is 1173, upper circuit is 1760. Okay. So the share price can't go above 1760 today. Now this will show you compared to 52 weeks history. What was the highest price? What was the lowest price? Okay. From this, it will show you market cap, and these are all fundamental analysis things. Yeah, PE ratio 40.68. We looked at it in fundamental analysis. So this is important in fundamental analysis. We'll look at it later. Even growth, EV to EBITDA is your growth ratio. That is also in fundamental analysis. All these are all fundamental analysis concepts. It will show you small summary there. All of this price to book value is also a fundamental analysis concept. So every stock, the broker will show it in this page. So it will be easier for you to do fundamental analysis rather than looking at a balance sheet. A balance sheet is usually hundreds of pages together. Instead of looking at everything, they give you a summary of everything here. So you don't have to calculate everything. Shareholding patterns, it will show you how many promoters or how much share promoters are holding. FIIs, mutual funds, insurance companies, other DIIs, non-institutional is retail investors. This non-institutional is the retail investor. And it will show you a small summary for today. What is the price performance? You can just go through this. You can try to understand how much you have. Then you can select some other stock now. Look at it. Use. You want to place a buy order. You can place a buy order. You can place a sell order. Apart from this, this is your main button, main section, which is the watch list section. You have the portfolio section. Portfolio section shows your holdings. It shows your holdings. What are the shares that you hold? How much quantity do you hold? So, holding is Adani Power, 2 shares I hold. Later, the last traded price, LTP for the Adani Power was 365. My investment amount was 863 rupees for 2 shares. The market value today is 731, which means I'm at a loss of 132 rupees, which is 12%. Sorry, 12 rupees loss in today. 15% loss here, 1.6% loss here. This is today, this is old one. Okay. So I can look at all my holdings here. If I want to sell something from here, let us say GTL Infra, I have 50, I want to sell 20, I will just go to sell. This is just a warnings thing. Okay. Scripts under surveillance. This is my SEBI. They just want to rule out any unusual activity like manipulation. So they put it under surveillance. It's just a warning symbol. Warning symbol. You just continue. You can sell from there. So you have 50 shares. Out of 50 shares, you want to sell how many you want. Let me say 25 shares I want to sell. Again, you can select limit or market. I want to put limit. I'll put 1.3 rupees. It will show what are the charges. It is just 3 paise charges. You place the order, it will go. And the UC is 1.1 rupees. That is why it is not allowing me to go at 1.3. It is giving me a 1. So I can go at 1.07. So that's it. So that's it for today. Anybody has any doubts? Tomorrow we look at primary markets, indices, introduction to them. Primary markets is important for you. Indices we look at futures and options, that's a separate class. If anybody is interested in fundamental analysis or technical analysis, I will be taking a class soon. After Cobalt Skies, maybe 3rd week of October, there will be a class on technical analysis. Fundamental analysis, not many people are opting, so I think I may not do that. If you people are interested, you can let me know. We can do that also. So technical analysis, for sure I will be taking. That will be a 3 or 4 day session. I will show you what are the most used technical indicators and techniques. That will be on 3rd week of October most probably. I'll let you know in the group. So anybody has any doubts? Anybody wants to ask something? Any doubts or want me to repeat something?
Stop loss.
Stop loss. Okay. Stop loss. He had not attended yesterday's session. Stop loss. Anybody wants to explain stop loss? If you want, like to. Anybody wants to? You can come in. As I said, this is not a formal class. This is an informal class. Anybody can do whatever they want. Come in. You want to come? Come. Come. Anybody wants to come? It's okay. Don't be shy. Anybody? Once you explain, you'll be able to know how much you have understood. By that, you will be able to correct yourself. That is the reason I'm asking for volunteers. Somebody come. It's okay. Okay. So I do that. So stop loss. Okay. Word there. Stop loss is there. Stop loss meaning you want to stop the loss that you are making. Okay. It means that let us say you have bought a share at 1,000 rupees. Any share. You think if you are buying a share, it means you think that it might go up to 1,200. Okay. But let me say your analysis is not correct. It might fall. It might be able to fall to 600 rupees also. If it had gone to 1,200, your profit would have been 200 rupees. But now your loss is, loss is now 400 rupees. Okay. You are not able to afford so much loss of 1,000 rupees. 40% loss you are not going to afford. Okay, so you don't want to afford so much loss. So you think that your maximum loss capacity, the maximum loss that you can make on 1,000 rupees is 100 rupees. Okay, so you have to set your stop loss price. Stop loss price. So that once in the falling market, when you are going to make a loss, instead of making 400 loss, you are minimizing your loss to 100 rupees. For this, you place a stop loss order. I will show you how to place a stop loss order tomorrow. For placing the stop loss order, you need to calculate at what price you want to set the stop loss. So to set the stop loss, you understand your maximum loss capacity and you understand the LTV. So 100 rupees is your maximum loss. So you have to sell it at 900 rupees. So it doesn't matter if it goes only up to 800 rupees or not. What happens actually, you won't be able to predict 100%. Okay, so your stop loss is 900, you set it at 100 rupees is your stop loss. The stop loss price will be 900. For example, let me take a ulta situation. Instead of buying, we shall sell short selling. We are shorting the same stock at 1,000 rupees. Shorting meaning your view is bearish. You are expecting the price to fall to 800 rupees. If it had fallen to 800, you would have made a profit of 200. But unexpectedly, it goes up to 1,300. When it goes up, you are making a loss of 300 rupees. But your maximum loss is again 100 rupees. So your stop loss will be 100 rupees added on the loss side. So your stop loss price is going to be 1,100 and not 900 because your loss is on the upside. So your stop loss will be on the loss side. So you set the stop loss at 1,100.
It applies both for buying and the selling.
This is for selling. That was not right. Stop loss you can set for anything. You want some problem in Rebecca?
No, yeah.
Solve that. Again, we'll go with shorting because that is the most confusing concept. Shorting. So LTP, that is the price at which I short was 2,250 maximum loss capacity is 2,000 rupees. What will be your stop loss price? Everybody calculate, not just me. These are last If you have any doubts, you can get them all tomorrow. We'll go through the concepts again. Or if you want to have a practical session, maybe we can arrange one session in between during market hours. That way I will be able to show you how an order is placed and how it is executed. Sorry, 2450. We will see if it is correct. Okay, so LTV is 2256, 10 shares. So the capital we are investing is 22,500. Okay, your maximum loss capacity is 2,000, which means if the total value goes down to 20,500, you are gonna sell. This is your stop loss for 10 shares. Okay, so if the value goes down to 20,500, meaning there is a decrease of 2,000 rupees, how will you make a loss of 2,000 rupees? When it goes up or when it comes down? You are shorting. If it goes up, come down. When it goes up, so if you make a loss of 2,000, you must sell. So making a loss of 2,000 on 10 shares will be making a loss of 200 on one share. Right? So one share price is 2,250. If it goes up by 200 rupees per share, you will make a stop loss. So 2,450 is the stop. You want me to explain again? So your maximum loss capacity was 2,000 on the launch. 2,000 ನೀನು ಕಳ್ಕೊಳ್ಳೋಕೆ ತಯಾರಾಗಿಲ್ಲ. 2,000 ಕಳ್ಕೊಳ್ಳೋದು ಎಕ್ಸ್ಟ್ರಾ 10 ಶೇರಲ್ಲಿ 2,000 ಕಳ್ಕೊಂಡ್ರೆ ಓಕೆ ನನಗೆ. ಅಂದ್ರೆ ಒಂದು ಶೇರಲ್ಲಿ ಎಷ್ಟು ಕಳ್ಕೊಬೋದು ನೀವು ಮ್ಯಾಕ್ಸಿಮಮ್? 200 ರೂಪಾಯಿ ಕಳ್ಕೊಬೋದು. 200 ರೂಪಾಯಿ ಕಳ್ಕೊಬೋದು. ಸೊ ಒಂದು ಶೇರಲ್ಲಿ 200 ರೂಪಾಯಿ ಕಳ್ಕೊಳ್ಳೋದಂದ್ರೆ ಲಾಸ್ ಮಾಡ್ಕೋಬೋದು ನೀವು ಅಂತ ಅಲ್ವಾ? ಲಾಸ್ ಯಾವಾಗ ಆಗುತ್ತೆ? ಈ 2,250 ಇಂದ ಕೆಳಗೆ ಬಂದಾಗ ಮೇಲೋದಲ್ಲ. ಮೇಲೋದಂದ್ರೆ ಎಷ್ಟು ಹೋಗಬೇಕು? 200 ರೂಪಾಯಿ ಹೋಗಬೇಕು. ಸೊ 2,450 ಹೋಯಿತು ಅಂದರೆ ಸ್ಟಾಪ್ ಲಾಸ್ ಪ್ರೈಸ್ ಅಂದರೆ. ಸೊ 2,450 ಹೋಯಿತು ಅಂದರೆ 10 ಶೇರ್ಸ್ ಅಲ್ಲಿ ನಿನಗೆ ಇಷ್ಟೇ ಲಾಸ್ ಆಗುತ್ತೆ. ಇದೇ ನಿನಗೆ 2,650 ಹೋಯಿತು ಅಂದರೆ 4,000 ಲಾಸ್ ಆಗುತ್ತೆ. ಇದನ್ನು ತಡೆಯೋದಕ್ಕೆ ನೀನು ಸ್ಟಾಪ್ ಲಾಸ್ ಪ್ರೈಸ್ ಸೆಲೆಕ್ಟ್ ಮಾಡಬೇಕು. ಸ್ಟಾಪ್ ಲಾಸ್ need not be placed as an order. You can keep it in your mind, watch the market, you can have different stop loss also. Okay. So that's all for today. Anybody has any doubt, you can ask or you can leave. Anybody wants me to explain something more, you can ask me. Tomorrow the session is going to be a little short day, so I will try to get some sums or some practical videos for you to understand something. And maybe if you want to have practical demo, any day lunch break 15 minutes you can finish a normal trade. Place in the normal order and execution. I can show you that. Any day 15 minutes. If you want to have it, we can have it. Okay. So to open an account, you can just go to Angel website, ZERODHA website. You click on sign up. You can do all the procedures there. 5 minutes max. You can upload all documents as a photo or a PDF. They'll get it. They can get the account active in 1 day. Okay. I can share you the referral links for Angel, ZERODHA and ANAND. ANAND is a full-time broker. I don't suggest ANAND. ZERODHA and Angel are too good. If you want to go for something better than that, Grow is also good. These three are better. Don't go for other brokers like 5 Paisa, Share. Their user interface is also a little poor, and the facilities that they provide is also little. ZERODHA and Angel one have the small cases. Small cases is like a small SIP. Instead of putting 5 lakhs together in mutual funds, these are all small scale mutual funds. ZERODHA and Angel both have tie-ups with small cases. That is one additional advantage.
ZERODHA ಮತ್ತೆ ಏಜೆಂಟ್ ಬುಕ್ಕಿಂಗ್ ಅಲ್ಲಿ ಓಪನಿಂಗ್ ಚಾರ್ಜಸ್ ಇದೆ, ಗ್ರೋವಲ್ ಇಲ್ಲ.
ಏಂಜಲ್ ಅಲ್ಲಿ ಫಸ್ಟ್ ಇಯರ್ಗೆ ಓಪನಿಂಗ್ ಚಾರ್ಜಸ್ ಇಲ್ಲ, ZERODHAದಲ್ಲಿ 500 rupees ಓಪನಿಂಗ್ ಚಾರ್ಜಸ್ ಇದೆ. ಅದಾದ್ಮೇಲೆ ಆನ್ಯುವಲ್ ಮೇಂಟೆನೆನ್ಸ್ ಚಾರ್ಜಸ್ ಇರುತ್ತೆ. ZERODHAದಲ್ಲಿ 500, ಏಂಜಲ್ನಲ್ಲಿ 300 ಏನೋ ಇದೆ. ಗ್ರೋ ಅಲ್ಲಿ ಫುಲ್ ಫ್ರೀ, ಬರೀ ಬ್ರೋಕರೇಜ್ ಅಷ್ಟೇ ಕಾಸ್ಟ್ ಆಗುತ್ತೆ. ಸೊ ಗ್ರೋ ಇಸ್ ಆಲ್ಸೋ ಗುಡ್ ಇನ್ ಟರ್ಮ್ಸ್ ಆಫ್ ಎಕನಾಮಿಕ್ಸ್. Grow only, I don't know if small cases is there, but Grow is preferred by everybody because there is no annual maintenance charges and overall charges. So Grow is also good. Okay. Thank you. Also,